Bitcoin just slipped under $90,000. At the same time, gold is knocking on the door of 5,000 an ounce. And some analysts are openly talking about a world where gold reaches $23,000 within the next decade. That contrast is the story. Because a lot of people still think Bitcoin and gold move together. They don't. Not in the way most people expect. Right now, Bitcoin looks quiet, almost boring. It's been stuck in a narrow range, drifting sideways while traders wait for something to happen. Gold, meanwhile, keeps printing new highs. Silver isn't far behind. At first glance, it feels backward. Bitcoin was supposed to be the exciting one, the fast mover, the hedge against everything breaking. So why does the old metal look stronger than the digital one? To understand that, it helps to start with a common misunderstanding. Many people treat Bitcoin like a risk asset, something that should surge when confidence is high and collapse when fear takes over. But that lens misses what's happening beneath the surface. Zoom out, and Bitcoin isn't really falling apart. It's pausing. Markets do this more often than people realize. Big moves usually come after long periods of frustration. Price moves sideways, conviction fades, and attention shifts elsewhere. That's exactly when other assets start to shine. Gold thrives in moments like this because it answers a very simple question. What holds value when trust gets shaky? Right now, central banks are quietly buying gold at record levels. Not traders, not speculators. Countries like China have dramatically increased their gold reserves in just a few years. That's not a short-term trade. That's a long-term signal. At the same time, the global money supply keeps expanding. More currency exists every year than the year before. When that happens, assets that can't be printed tend to reprice higher. Gold has been doing that job for thousands of years. And that's where the $23,000 number comes from. It's not a guess. It's a projection based on past periods when money supply grew quickly and real assets had to adjust. If history rhymes, gold doesn't just creep higher. It resets to a new level. Bitcoin fits into this picture differently. Bitcoin doesn't respond first. It responds later. In previous cycles, Bitcoin often lagged traditional safe havens before making its biggest moves. While gold absorbed fear, Bitcoin absorbed liquidity. Right now, Bitcoin traders are watching very specific price levels, areas where price tends to gravitate, stall, or snap. Think of them like magnets. One of those magnets sits just above $93,000. Another sits lower, in the mid-80s. If price loses support and doesn't recover quickly, the market usually tests lower ground before deciding what comes next. That sounds technical, but the idea is simple. Markets don't move because of predictions. They move because of positioning. When too many people expect one thing, the market looks for another path. That's why bullish Bitcoin predictions have gone quiet lately, and why gold forecasts are suddenly everywhere. The interesting part isn't which one wins this month. It's what they're responding to. Both are reacting to the same background forces: rising money supply, geopolitical uncertainty, and a slow shift away from trust in paper currency. Gold reacts immediately. Bitcoin reacts explosively, but later. That delay is why Bitcoin can feel disappointing right before it isn't. So where does this leave someone trying to understand the bigger picture? Gold is acting like a pressure gauge. It's telling you that something is building underneath the global system. Bitcoin is acting like a compressed spring, quiet, tense, waiting for release. Neither behavior is random. They're two different responses to the same environment. If gold really does continue toward those long-term targets, it won't happen overnight. It would mean years of adjustment, not weeks of excitement. And if Bitcoin eventually follows, it likely won't look obvious beforehand. It rarely does. What matters is recognizing that sideways doesn't mean broken, and calm doesn't mean finished. By the time price action feels exciting again, most of the learning opportunity is already gone. If this helped you see the relationship between Bitcoin and gold more clearly, that's the win. The next natural question is how these cycles tend to unfold over longer time frames, and what usually signals a real shift before headlines catch up. If you want to explore that, let me know in the comments what you'd like to dig into next. And thanks for spending a few minutes thinking this through with me.